Hey everybody, Economic Ninja here. Let's talk about real estate and how it is affected by the interest rate cycle, right? Interest rates are one thing, but an interest rate cycle, like let's say you go to buy a house and you're like, I want to buy a house today. I've finally figured it out. I've saved enough money. My credit score is good. Let's go buy a house. And you go look, and today the interest rate is at 6.5%. All right. That's one thing to consider when you're going to buy a house. Can I afford it? The other thing you want to do in considering buying a home, and I go into much more detail on this on the course, but you want to know where we are in an interest rate cycle, right? Because the Federal Reserve decides what the interest rates are going to be. Now, from day to day, the bank decides what it wants to be inside of a tiny little window, a tiny little size amount of mortgage rates. Because it wants to be competitive with other banks, right? But by and large, all banks, all mortgage rates are affected by a couple of different methods or metrics, whether it be LIBOR or the 10-year bond. They are going to be affected by a certain rate that ultimately is decided by the Federal Reserve. And the reason why is because the Federal Reserve sends the baseline interest rate out, the rate that all banks deem as safe, where they can put money on loan with the Federal Reserve at a certain rate, and then they can decide to make a little bit more or a lot more, depending on how much risk they want to take on, right, to their portfolio by lending it to you in the form of credit cards, mortgage rates, student loans, all kinds of things, all right? So ultimately, the Federal Reserve has total control over the pricing power or the price of mortgage rates, okay? It just depends on how much risk a bank or any bank wants to take on. All right. So it's very important that you understand where we are in the entire cycle, because it just doesn't randomly happen. The Federal Reserve doesn't wake up one morning and go, rates are at, 6% for a mortgage, they're 5% or 4% for the Fed funds rate. Let's take it to 1%. Oh no, today, let's take it to 10%. They just don't do it. They base their interest rate off of the health or sickness of the economy. Okay. And what's important to know is that they don't just randomly one month they lower a raise and then they wait 10 months and then they do it again. They go through full cycles. They raise slowly, month over month, boom, and then something happens, it tops, and then they start to lower. And these are multi-year uh, situations that happen. But if you know and can understand when they happen and when you're supposed to buy a home and when you're supposed to sell a home, you can make so much money on the actual cycles of real estate as opposed to holding a property with monthly cash flow. Now, with that being said, if you have great cash flowing properties that have very little maintenance and you don't have to worry about them, there's no reason to ever sell them, right? There's no reason. But when you're speculating in homes and you're speculating on the value of the home, the appreciation going up or going down, that's a totally different ballgame. All right. Now, that's what's great about real estate. There's like 5 different ways to make money from real estate, and these are just 2 of them: cash flow and appreciation or depreciation. Well, depreciation is another way. All right, so let's talk about that. A lot of people ask me, when is a good time to buy a home? And my easy answer is when you're going for value and appreciation, the best time to buy a home is when interest rates are at a historical high in whatever interest rate cycle you're in. Now, there's a lot of debate over to whether normal cycles can go anywhere between, and it used to be prior to the year 2000, normal interest or mortgage rate cycles could go anywhere from a top of, let's say, 18.5% in the extremes down to a low of 6%. After the year 2000, when we had the dot-com crash and subsequently 9/11, that tragedy, we had seen the Federal Reserve do something that it had never done and brought rates to historical lows. As a matter of fact, the Fed funds rate got as low as 25 basis points or 1/4%. That brought interest rates or mortgages super low, down into the maybe at the best high 4s, but primarily the mid 5 range, okay, for a 30-year fix with a conforming loan with good credit. That was great. That actually caused the value of homes to skyrocket. Why? Because the cost of the home, the principal and interest, ended up being so low. The interest cost, which is primarily especially in the beginning, if you look at an amortization schedule, it's the largest part of the mortgage, right? So when interest rates are low, that largest part of the mortgage shrinks. Well, what does that do? It causes rampant speculation because more people can now afford a home, a condominium, or an apartment. And the ones that already own a home, they can go, heck, we could sell this and now we can afford a McMansion. You know, the tiny little mansions that we can look really important and rich in front of all our friends. Even if they are leveraged to the nine and they are dead up to their eyeballs, they look rich. So it causes human emotion to dive in and cause rates to explode, right? Well, what happens when the Federal Reserve raises rates? Everything stays fine until they start getting really expensive. And then you take the cost of the house, the cost of the interest rate, and what happens is people panic. A very small amount of people panic. The volume of sales starts to slow, right? And prices actually explode higher. Why? Because the dumb money, I call it, dive in because they're afraid they're not going to be able to get their McMansion and show off with their friends. And then you also have the slow to the market home buyers, the ones that always were making excuses, never finally made the commitment. Now they panic because if they don't buy, and I quote, we'll never be able to buy ever again. Okay? Then it tops. And then what we see as interest rates top and the economy starts to slow and home sales start to not only slow, but now you add on home prices start to drop because more inventory starts to hit the market. We see the Federal Reserve start to lower rates. And then as they start to lower rates, it takes some time for buying activity to pick up. Why? Because humans are slow to the game. They are slow to react. Very few of them understand this cycle and dive in right at the proper time. And a good investor also knows it's not time to dive in because you want the peak amount of panic. And there's certain indicators that prove and show when we are at peak pain in the market, right? And that's when you start to buy again. Now, in 1980, Paul Volcker, I'm sorry, I don't remember what year it was, the early 80s, I want to say it was 82. That's a guess. Put down in the comment section what year it is. He had to spike rates, the federal funds rate, which caused the top end, the higher echelon of mortgage rates to hit around 18 and a half, 18 and 3/4%. Now you have to understand that before that, the average was between 9 and 11, maybe 12% on mortgages. So when they took that up, it severely crippled the real estate market. Sales halted, and there in a lot of locations, there were price drops. There was nationally a small price decrease, but you have to remember, back then, based on wages, the cost of the home based on wages was a much smaller amount as it is today. So it didn't have as big of a drastic effect as what happened in 2005 and what happened in 2017, 18, and now what is happening now. Okay, so much different because the average wage was much closer to the cost of a home back then. Okay, but it did have an effect. So we've seen times where investors can buy at the top end when you can buy a house at 18% mortgage rate, right? And it's breaking even or cash flowing with a proper amount of down payment. Then what happens as the Federal Reserve starts to lower rates, those investors start to refinance on the way down. And what they see is their cash flow on a percentage basis explodes higher, right? But at the same time, after a while of interest rates going down, more people start to dive into buying homes. And since you have now all of a sudden more buyers than borrowers, more buyers than sellers, the price of the home starts to pick up. So you have this perfect storm. You buy your home at a high interest rate when you believe the Fed is close to pivoting, right? And that's a guess. It really is an educated guess. And the best way to make sure that you're a success in this is that you have the proper cash flow. You buy the deal right. You don't race in and just buy any home or any apartment complex. You make sure that you have the proper amount down, you have a fixed rate, and you have a good solid amount of cash flow and emergency reserves on the side. Because then let's say you're wrong and the Fed has to raise a little bit and there's a little bit more pain. If you bought the property right with the right metrics, right? The right down payment, it's a fixed rate, the right type of loan, and you have emergency funds and you are cash flowing a proper amount to where you can keep that property going, then it's okay because then you look for the next deal. But eventually the Fed will always start to lower because the economy starts to crack. Most people don't remember back 7 to 10 years, which is a normal recession cycle anyway. Historically, recessions happen every 7 to 10 years. And mostly they're 7 years. Every once in a while you get out of whack and get one out of extends 10 years based off of Fed monetary policy. So my point being is that you want to buy when interest rates are highest and the pain threshold, the pain is at the most. Max pain for the home seller. They cancel their home. You want to buy it. You want to get the lowest price valuation possible for the home. And then as interest rates go down, you refi all the way down and your cash flow explodes at the same time the value of the property jumps up. I hope you guys got something from this. I thank you so much for watching. The Economic Ninja is out.